Alrighty then, we're going to talk today about the SaVE. Hey there and welcome. My name's Dave and I am the Wall Street Cowboy. Thanks for stopping by. Today we're going to talk about the SaVE trade. This is one of my very favorite trades, and in fact it may be my very favorite trade. I came up with this back in 2015 after we had a pretty sharp sell-off in the market in August of that year. So we're going to talk about when you enter, when you exit, when you modify it, when you don't, and hopefully give you a little bit of background on how this trade came about. This is a really great trade that could be appropriate for your account. This is a trade that you can make money with on a monthly basis or at least a semi-monthly basis. And it also protects you in case that we have a pretty substantial move down in the market. This is a remake of a presentation I've done a few times, so sit back. It's going to take about an hour. There's a lot of information to go through on the different characteristics of a trade. You can't do it in 15 minutes, so grab yourself a nice cool drink, an iced tea or something, a cup of coffee, and enjoy the ride. So again, if you like what you see, please hit that subscribe button for me. Leave a comment down below. Let me know if I got something stuck in my teeth. I'd sure appreciate your comments. Thanks, and here we go. It's not necessarily a new trade. It is something that's been around in a form similar to what I've done by many hedge fund managers to protect their account. I use it for not only protection but also for monthly income. So I'm going to talk to you today about how we enter into this trade, how we maintain it, when we maintain it, what's the criteria for that, and then we're also going to talk a little bit about how we exit. There's a number of different exits for this trade, so we're going to go through a few of those and let you set up a way for you to enter and exit according to your own trading style and trading plan. Okay, well, let's go ahead and get started with our disclosures. As you know, we are not financial advisors. We're not broker-dealers. We don't make recommendations or suggestions for your particular situation. We have not done a needs analysis, nor do we know anything about you. We couldn't possibly know if this is right or wrong for you. We do use a paper money trading account for all of our images. By virtue of it being paper money, it's hypothetical in its nature. Now, investing does have risk, and you can lose all or some of your money, and depending on the type of leverage you use, you could lose more than the money you intended. So please be sure you understand investing before you start a regimen of trading. There is a guide that's available from the CME called The Characteristics and Risks of Standardized Options. We do suggest that you get a copy of that from your broker-dealer and become familiar with it and understand all of the nuances, good and bad, for futures. We don't have any testimonials on here, and if we did, there is no third party that has gone through to verify the accuracy of those. So just remember that you should know everything about your investing before you invest even the very first dollar. So let's go over the SaVE trade guidelines. First of all, this trade does require portfolio margin. Now, you can use span risk. Span risk is a type of leverage that is available to futures traders, especially those that trade options. Now, your broker-dealer may or may not offer span, and it is most often something that is used if you're trying to do a trade like this in an IRA, because IRAs do not permit portfolio margin. So you may have a very large IRA account that you want to do this in, and that would be fine if you use span risk. So please refer to your broker-dealer. There are some that offer it, some don't, and some offer it in their IRAs and some don't. So check with your broker-dealer. Now this trade is going to last approximately 45 days. There's sometimes it's going to last a little bit longer, and sometimes it's going to be a little less. I've been in these trades as little as a week or two, and I've reached my profit target. Now that is unusual, but if you will allocate 45 days to this trade, most times you're going to be right in there. So it's something that will roll over about every month and a half, and you'll reach profit target and be able to put on a new one for new income. The max loss on this is $10,000. Now, I don't want to scare you with $10,000. That is what we call the line in the sand. That is the point at which we begin to do some adjustments. And if we can't hold the trade from taking on additional losses, we will exit the trade way before a $10,000 loss. In most cases, I will take this thing off before it even reaches $3,000 in losses. Now, you will have to have a margin account, which is the portfolio margin side, and you will have to allocate $25,000 of margin for this trade. Now, I don't suspect you'll ever need $25,000. There will be times in certain situations where you could approach $25,000. You can see that there's an asterisk right after that, $25,000. In most cases, this trade only uses between $6,000 and $8,000 of margin, but in the right situation, that could rise up to $16,000, $17,000, $18,000 of margin per tranche. Now, a tranche is what we call a unit, and you can have multiple units of this trade. And so for each tranche, you would need $25,000. So if you wanted to have, say, 4 tranches, because you have a very large account, then you would need $25,000 for each tranche or each unit. So depending on the size of your account, you will know how much margin you need to allocate or set aside just for this trade. What you don't want to do is get into this trade and then have to start closing it because you have exceeded your margin requirement as outlined by your broker-dealer. I always like to give a little history on a trade. Sometimes if you know the history of the trade, you can better trade this strategy. This was born out of a group called the OTFI group. That stands for Options Trades for Income. A good friend of mine, Ray McCarty, and I came up with a group in the Invest Tools community when there was an Invest Tools community called the OTFI group, where we would talk about trades like this, where you could put on a strategy that would generate monthly or regular income. It could be annual if that was the criteria that you were looking for. It could be weekly. So we had a number of different trades, and we had a number of different really good traders that would contribute what their experience was. The OTFI group is still around, and I still post in there, and you are welcome to go there on Skype. I think there's another one on Slack. I'm not in there all that often, but I do make postings in there about this and other trades similar to it. So this is an example of some of the postings that come up regarding the OTFI, in the OTFI group regarding the SaVE trade, and I'm pretty frequently in there as well as other people with their SaVE trades, so you can learn a lot about how we are managing this trade through different storms as they present themselves from the market. In its infancy, this is how the SaVE trade started out. I created something called a mini hedge. Now, the whole purpose of this trade was to create some kind of protection against a big move down, a crash, if you will. All this is a very typical bull put spread with 10 contracts on the SPX. And I would take the credit from that and use it to buy one extra long put. Dissecting this image, we've got an expiration line, which is this blue line, and then we have what's called the T+0, and some people call this magenta line the gamma line, but that gives you the return if the market, or in this case the SPX, is at that particular price on that particular day. And this is looking at today. This doesn't have any forward-looking bias to the magenta line. That is today. Now you can give it a forward-looking bias, but in this picture it's just today. So if we were to put this trade on and then immediately have a crash, depending on the changes in volatility, it could be a very profitable trade. The big problem with this trade, it had two of them. Number one, it got worse with age. The longer you stayed in this trade, the more that this magenta line would start to drop down into what I call this bog of eternal stench. And it would become more and more risky. It would become very directional. So you wouldn't ever be able to hold it all the way to expiration, or you would take on a tremendous amount of risk, which is the second problem. You're using $12,500 approximately of margin to make about $359. The $359 really didn't excite me very much for $12,000 of risk, but what was nice was I was getting paid to make a hedge that would protect me. Again, the bad part was that it would get worse and worse as time went on. So I needed to make a change and look at some other opportunities. But this trade was used to protect a much bigger trade that would make more income. This is another trade that I came up with. I call this my Polar Express, and it's after the very popular Christmas movie where there's a scene where a train is headed towards a mountain, which is where the North Pole is, and it's slip sliding from right to left, and what they're trying to do is catch a very narrow passageway right in the middle of that mountain, which is represented by this profit tent, that blue line that has a kind of a triangular look to it. And you would adjust this trade slightly every time it got too far out of the center, and bring it back to center depending on what was going on with the market. The big problem with this trade, which is inherent in a lot of trades like this, is that it has too much risk if the market gets into a sustained rally or into a sustained pullback. So if we look over here, we would start to lose money if we got too far out here, and we'd lose a whole lot of money if we started going down. So there's a lot more risk to the downside in the event of a crash, which is why I needed that protection that would offset that from my mini hedge. As you can see, there is a very big risk area here in that red box, which is one of the drawbacks to a strategy such as this. It's not unique to a Polar Express. We have the same kind of a thing in a broken wing butterfly, if you will. We could lose a lot of money if we get a sudden pullback. The same thing is true in a regular bearish butterfly. We have two sides of a butterfly that can get into trouble, and if you have a sudden move one way or the other, you can have to do some quick shuffling to keep this trade in profitability. Even just a very typical bull put, which, remember, this is the basic form that we create the mini hedge from. Instead of doing 10 that we sell and 10 puts that we buy, like we do in this bull put, in the mini hedge we would buy an 11th one with that $2 credit and end up with one extra long put so that we would have some protection to the downside. But you can see that we had this same kind of problem with a lot of different strategies. It wasn't just unique to the Polar Express. So in 2015, in fact August of 2015, I was in a trade similar to this. It was a Polar Express, except I was up pretty good on the trade going into a Thursday just before monthly expiration. I thought, okay, well, I'll just hold it over the expiration. I'll get a little bit more money from it from theta, because it's a theta-rich trade, which means it makes money with the passage of time. And I thought, I'll just take it off on Monday. Well, Monday morning came along, and I got caught in a buzzsaw because the market came all the way down here into this bog of eternal stench, and I got cut to ribbons. I ended up losing some money on that trade, and I decided that, you know, I got to come up with a better plan than this and have some protection against an event that I didn't see coming, a Black Swan type event. So I went back to my mini hedge and I started working with it, and I thought, okay, you know, this is a good start, but you know, that $359 just wasn't going to be enough. I wanted something better than that that would give me pretty good protection against a crash or a correction. So the first thing I tried was to move my strikes further apart, thinking, well, maybe I'll get a bigger credit that way. And although that did happen, what the bad part was that this T+0 gamma line started to sink way down into here, into that bog of eternal stench, and I thought, well, that's not going to do. We need something different. So I gave it some more thought, and I thought, well, why don't I calendarize it? In other words, instead of having both the same month, March and March, or February and February, why don't I calendarize it so that I have my short strikes in March and my long strikes in February? Well, you can see from that green arrow, I increased my credit tenfold. I went from $300 up to $3,000 in credit. That was pretty enticing to me. So I started working with it and decided, okay, let me go ahead and do some back testing using Option View. And Option View, I learned quite a bit. I went back in time and did 2007, 2008, and 2009. And in 2007, I had a pretty good year. This trade did awesome, but the market was acting pretty normal in 2007. And I think the end result was, for the dollars I had at risk, I made a 200% return, which is very good. And then we got into 2008, and that was a pretty turbulent year. And back in 2015, 2008 was the year to backtest against, because that was the year that had the most volatility. So I backtested it through there, and although, you know, there were some good months and there were some bad months and some pretty bad months, at the end of the year I was still up almost 100%, which I was pretty happy with. And then in 2009, things started settling down, so that back tested pretty well and ended up getting up close to about a 200% return. So I decided that I would go from back testing to paper trading. And I started paper trading this and working with some different scenarios. In other words, you know, do you do sell 10 and buy 11? Do you sell 10 and buy 20? You know, what was the change? How far out of the money should you go? You know, what months were better than others? Should you do 2 months separation between the long puts and the short puts. I mean, all kinds of things. I went through 6 months worth of paper trading, trying different scenarios, and I found different success rates and started narrowing down to what I felt would be best for a normal market. So then I started doing more back testing, and I started finding that T+0 line would sag quite a bit depending on different scenarios. In other words, how deep would that T+0 line sink into that bog of eternal stench before it would get to a point of no return. And then I began to look at this and say, you know, it never does get down into that horrible place, the very pit of hell, down there at a $70,000 loss. And why did it never get down there? I mean, even in a bad month, it never got way down in there. So I wanted to understand that better. Well, I got my opportunity in January of 2016. Now, that was, 4 or 5 months after the August correction. We started a new correction, and in some ways this was worse than August because it's what we call a slow melt. It would slowly go down 20 or 30 or 40 points, and then maybe bounce 8 or 10 and then go down 20, 30 or 40 points. It didn't drop 100 points and 100 points and 100 points. It just slowly melted down, which really created a problem with that T+0 line. It would just start to sag more and more. So I understood that the illusion was real, that there was a real risk to that valley of death, or the bog of eternal stench. So I held on to the trade, and what ended up happening is we ended up getting a pretty good bounce, and it pulled out, and I ended up making 3 times what my target was originally. So let's assume that I wanted to make $2,000 per tranche. I ended up making $6,000 per tranche because of the rebound or the bounce by holding on to it. So the illusion is real. If it had stayed there, I could have taken a pretty big, severe loss, and it would have gotten worse and worse. But because I was able to give the trade time to work itself out, and I had plenty of duration in the trade, the market eventually did bounce, and everything worked out very well. So let's kind of go through this and see how that worked out, because this will help you to manage this trade if and when that happens to you. So again, the blue line is the front month expiration. This trade does not expire in the front month. It expires a month later. So what I was focusing on in that really big V bottom was the front month expiration. It wasn't focused on the actual expiration of the trade. Now, keep in mind that we're never going to ever hold this trade till expiration of either the long or the shorts. But I needed to see this for what it was and see why our P&L never really got below $10,000 or $12,000. I think it was at one point, when it clearly shows there that I could have lost as much as $70,000 in the wrong situation. So I changed the settings on the Thinkorswim platform, so now I could see a gold line, which is the front month, that's that big V bottom, and the blue line became the expiration a month later, and the magenta line was the T plus 0, or today plus 0 days. And now the trade began to make sense. So where it looked really bad with that V bottom, and that is an illusion, and it is real to an extent, if I held this trade all the way to expiration, I had lots and lots of room all the way down to where that blue line started to really fall off the edge of the cliff and start to really descend quickly. So I started looking at that as a way to be able to gauge when I should adjust this trade. What I ended up doing is I changed the risk profile. So this is how I look at this particular trade. Now that gold line, or that big V bottom, it's there. I just changed the color of it to be white so it blends into the background. But if you look real closely, you could actually probably see it on there. And that was the illusion. As long as I held this trade and didn't allow it to get down beyond where that blue line started to really descend into hell, it was not in all that much trouble. However, there's a comfort level that says I don't like where this trade is, and I would adjust it before it gets into that much trouble. So I learned a lot about the trade. While I would never hold it all the way down to where the blue line starts to descend, and basically what that means is that my short strikes were in the money, I would never hold it that long. I would have long since gotten out of the trade before that happened. If it did get down there, I had plenty of room and time to make an adjustment. So now I had to focus on how to adjust the trade. But I learned a great deal about it. So now it was time to go from paper trading to live trading. So I started live trading this for about a year before I really started talking about it to anyone. And so now let's go through the guidelines of what this trade is, how you put it on, how you manage it, and how you exit the trade. First of all, as we talked about, this requires portfolio margin. I'm going to be in the trade about 45 days usually. The max loss is $10,000, although I'm always going to exit well before $10,000, but that becomes our adjustment point. When $10,000 becomes a possibility and we can no longer keep it from being a $10,000 max loss, even if we're only down $1,500, we're going to go ahead and take the trade off. But as long as we can keep our max loss at $10,000 or less, we're going to stay in this trade. And then, of course, the margin requirement is $25,000 of portfolio margin per tranche. Now, what we're going to do is we're going to sell 10 120-day out, or days till expiration, SPX puts. Now, you can use the Russell if you like. You're going to have a lot more volatility with the Russell than you are the SPX, so you potentially are going to have more adjustments. If you're comfortable with that, then you can do this on the Russell. The trade-off is that you'll probably make a little bit more money with the Russell than you will the SPX. So you raise the risk and you also raise the reward. But for these examples, I'm not going to use the RUT or the Russell. I'm going to stick with the SPX. What we're looking for is whatever strike that is in approximately 120 days till expiration option chain that is trading at the mark of about $10 each. So there is a bid price and there is an ask price for every single contract that is in an option chain. The mark price is halfway between the bid and ask. So if the bid is $10 and the ask is $11, the mark is $10.50. Halfway between 10 and 11 is $10.50. It's pretty easy to find. So I'm going to sell 10. Now, I'm not always going to be able to find something that is exactly $10. Sometimes it'll be $10.20. Sometimes it'll be $10.90. But I never pick one that's below $10. In other words, if it was $9.95, probably okay. If it was $9.80, I would not choose that strike. I would go to the next available strike that is at $10 or higher. There is one other nuance. I only use the strikes that are trading at a $25 increment. In other words, they have to be multiple or divisible by 25. So a 2000 strike, a 2025 strike, a 2050 strike, a 2075 strike would be fine. A 2010 strike, that's not divisible by 25. It's a $10 increment. So I like to stay with the $25 increment, and it has to be divisible by 25. The reason, if you look at your option chains, that's where the most liquidity is. That's where the most open interest is. That's where the most volume is in almost every case. There can be some but nuances to that. But for the most part, the 25-point increment is where the volume is. And I look for the $25 increment strike that's 120 days out till expiration, that's trading at $10 or higher. Then I'm going to take that credit. I'm going to sell those. So 10 times 10 is $10,000. I'm going to bring in that $10,000 and I'm going to use that $10,000 to buy 13. Notice it's 3 more than I am selling. I'm going to buy 13 of the same SPX, same underlying, except I'm going to look for one that is at 90 days till expiration. So that's going to be a completely different option chain. It's going to be 30 days less in duration. So the short, or the ones I sell, are 120 days. Now if it's 123, that's fine. If it's 119, that's fine. I just don't want it to be 141. That's too far out. I want to wait until they're right around 120 days. Give or take 5 or 6 days is fine. And then the long, or the ones I buy, are going to be about 30 days less till expiration. And I'm just going to go find the one that's at $5. Again, I'm going to stick with the ones that are trading at the 25 increment strike. So I could sell the 20,000 or 2050 and I could buy the 2025, but I wouldn't sell the 2050 and buy the 2010. And I want them both to be very liquid so I can get in and out of these very, very easily. Now I'm going to enter that trade on the week usually the Monday, that follows monthly expiration. Now there can be a confusion here. There are many different option chains or many different expiration cycles. There is a month end, which is the last day of the month, and they have one every month that expires on the last day regardless of what day that is. It could be a Monday, Tuesday, Wednesday, Thursday, or a Friday. Then they have what we call the monthlies, and these come out every month. They've been coming out for years and years as monthlies. These predated and pre-existed the weekly options, which we have now in the SPX, and they stop trading on the Thursday at the close of trading on the third week of the month, and they settle on the morning of the third week Friday. So they are called AM settlement because they actually settle on the morning of the Friday, the third Friday of the month. Now there is one that's called the SPX PM, and it's a weekly. It stops trading on Friday. It doesn't stop trading on Thursday. It stops trading on Friday at the close, and it actually settles in the next day on a Saturday, but the market is closed on Saturday. So except for the little bit of change that can happen right after the market closes on Friday, these keep trading for about another 15 minutes. Except for that little change that can happen in there, the SPX PMs are pretty much the same at expiration as they are at settlement. Now these the regular monthlies can have a very different settlement because a lot of things could happen overnight, and on Friday morning the market could be very different than it was on Thursday night. Now that's really not going to matter much. It's just a little bit of trivia to know, because we're never going to hold these things till any expiration. We're going to get out of these well before. Remember, it's about a 45-day trade, and we're getting a 90 and 120 day to expiration option. We're never going to have these anywhere close to that front month, which is the 90-day expiration. The front month is the one that expires first. The back month is the one that expires last. So we're never going to hold these all the way to expiration. But that tells you which option chain to look for. So this trade requires portfolio margin. We're going to use the 120 day to expiration options, and we're going to sell 10 of those at $10. We're going to use the 90 day to expiration options, and we're going to buy, but we're going to buy 13 of these, and we're going to look for the one that's trading at about $5. Is it okay to use the $4.95? Of course it is. Could it be $5.20? Of course it could. That's just fine. But what you want is the spread between the short one, the 120 day to expiration, and the long one, the 90 day expiration, to be $5. You take $5 from $10, that's a $5 spread. That's what you're looking for. As long as it's right around $5 for that spread between the long and the short, that's just fine. It can be $5.20, it could be $4.95. It just needs to be right around $5. We're going to enter the week after monthly expiration, usually on the Monday, but Tuesday or Wednesday would be fine. The initial margin, remember we told you that you needed to have about $25,000 set aside. You're never going to need all that $25,000. I always like to overdo it a little bit as far as protection. this trade's going to use about $8,000 of margin. Sometimes as little as 6, sometimes as much as 9, but right around $8,000 will be about the margin of the $25,000 that you are setting aside that will be required for each tranche. So if you do 2 tranches or 2 units of 10 and 13, then you would need $16,000 of margin. That'll be about average, and you could be a little bit more, but you'll have to set aside $50,000 of margin just in case. So you must assume that the margin can inflate by 200%. In other words, if it went up 100%, it would go from $8,000 to $16,000. If it went up 200%, the margin could approach $25,000. I've never ever seen it hit $25,000. In all the trades I've ever done, all the back testing I've ever done, I've never ever seen it get close to $25,000. I have seen it get close to 16. But I want to always make sure I have plenty of room and I don't run into trouble with my broker-dealer. Now, there are 3 ways to exit this trade. There's A, B, or C. We're going to go through a couple of those and see which one works for you. There are actually 2, or actually now a 3rd way that you can enter this trade. This is the main way that I use. I call this my SaVE Trade 1. My SaVE Trade 2 uses a little bit different ratio. The ratio is the sell 10 and buy 13. The ratio is slightly different, and there's one other thing I put in it to help out with the trade. But we'll talk about that in another video. That will be the SaVE Trade 2 and the SaVE Trade 3. Alright, so let's go ahead and do the math on this. We're going to sell 10 puts at about $10. Now, I'm just going to use simple math. I'm not going to go into $10.20, so let's just keep it simple. It will vary slightly, and we know that. We're going to sell 10 at $10. We're going to bring in a $10,000 credit. We're going to buy 13 at $5. 13 times $5, or $500, because that's what $5 is, and that's what, $10 is equal to $1,000, and $5 is equal to $500. So 13 times $500 is $6,500 debit. So what is the net credit? If you take $6,500 away from $10,000, you got $3,500. That's the credit that comes in. Remember, the mini hedge brought in $350. This brings in about $3,500, or 10 times as much. Now let's talk about the absolutes. There is intrinsic value. That's an absolute value. The intrinsic value, by definition, the only options that have intrinsic values are those that are in the money. So if I had a stock that was trading at $100 and I had a call at 95, that means I can buy it at 95. It's already trading at 100. It's $5 in the money. It has $5 of intrinsic value. Now, if the cost of that option is $7, that has $5 of intrinsic value and $2 of extrinsic value. Now, extrinsic value is the implied value of an option beyond its intrinsic value, and it's based on the perceived time value, or theta. Implied volatility also affects the price, and so does changes in interest rates. And there are some other, second and third order Greeks that play into it, but the absolutes are there are intrinsic values and extrinsic values to options. All out of the money options the ones that we are working with, anything that's at $10 is going to be way out of the money. Those options, when they expire out of the money, and assuming that they do expire out of the money, all options that expire out of money will expire worthless because there is no intrinsic value. They're not in the money, and the extrinsic or time value has it completely exhausted. So let's look at the effects of time. The initial spread is $5. That's the difference between $10 and $5 on the ones we sell and the ones we buy. As long as the options remain out of the money, the value of that spread should melt or go down to zero if they remain out of the money. That is how we make money in this trade. So let's take a look at this. In scenario A, we're going to sell 10 puts at $10 and bring in $10,000. We're going to buy 13 at $5 and pay $6,500. We're going to end up with a credit of $3,500. We are then going to place a good till cancel order to exit this trade when it is at 50% of the initial credit, or $1,750. Now that could happen in 3 weeks, it could happen in 45 days, it could happen in 60 days. It just depends on what the market does in between the time you enter the trade and the trade expires. So sometimes that's very quick and sometimes it just takes longer. But at some point, assuming that these options remain out of the money, the price of this spread will decrease from $5 down to 0 or pretty close to 0. And if it remains extremely out of the money, it will definitely go to 0. So at some point, we're not going to hold it all the way to expiration, remember. At some point, we'll be able to take $1,750 of that $3,500 credit, use it to buy back this position. In other words, close it out. We're going to buy 10 puts and we're going to sell the 13 puts and end up with $1,750, which is the balance of the $3,500 after we buy everything back for $1,750. Now, that doesn't include slippage and commissions and fees, but it's going to be approximately $1,750. This should occur at about 46 to 60 days in the trade, DIT, days in trade. And that's just a very simple scenario. You can do that. You can put this trade on and really simply forget about it. I say that with tongue-in-cheek. You should check on this every day, and especially if we're having a particularly bad day, you want to check on this. But if the market is just kind of going through its motions as it normally does, come back a day or two from now and you should see that your trade is up $100 or $200, and then come back another 3 or 4 days, it should be up another $200 or $300 again. And as soon as it's up $1,750, your good till cancel order should be ready to fire off and get you out of this trade. It's pretty low maintenance if we use scenario A. Scenario B is a little bit different. Now, what we're going to do is use the same math. We're going to sell 10 at $10 and bring in $10,000. We're going to buy 13 at $5 each. We're going to spend $6,500. We're going to end up with a $3,500 credit. Now, I want you to think of this not as a ratio, 10 and 13, But I want you to think of it in scenario B as a spread that has 10 longs and 10 shorts. And it's a diagonal spread with 3 extra long puts. Hopefully that makes some sense to you. The 3 extra long is the 3 from the 13. So now the initial spread price is about $5. That should make sense to you. We're going to place a good till cancel order to close that spread, the 10 and 10. We're going to buy back the 10 shorts. We're going to sell the 10 longs as soon as they get down to $1.50. Now, if you want to put it at $2, that's fine. If you want to put it down at $1.25, that's fine. I'm just going to do this for simple math. That should happen right around 45 to 60 days into this trade. At about that time, your spread should be at about $1.50. So let's go through the math. We brought in $10,000, we spent $6,500, we ended up with $3,500 in credit. We're going to put in a good till cancel close of 10 and 10 at $1.50. That's $1,500 that we're going to spend. What does that leave? $2,000. So now I've got $2,000, but what is the bonus? I got 3 extra long puts. Now remember, this is a SaVE trade. It got its name from the Saturn V rocket. The Saturn V rocket started off with this very big structure, and then it would start dropping things off. So we start dropping off these spreads, these $5 spreads. And then we end up with 3 long puts at the very end. Now this will take a little bit longer, but you can hold these long puts, and they will be there for, you can hold them till expiration. Another scenario is to sell one of these long puts when they drop down, to, I don't know, $100, $200. You're gonna buy them for $5. Maybe you can sell it for $125 and get an extra $125. You lose some of that protection. But what this did was exactly what I was looking for from this hedge. I wanted something that would give me regular income. Now, in this case, I showed you a way that you could make $1,750. Another way you could make $2,000. The $2,000 would leave you with 3 extra long puts. You can actually make a little bit more by selling 1 or 2 or all 3 of these long puts at perhaps $1.25, $1.75, something like that, and bring in a little bit more. However, remember, these are free. You have no more risk. The long puts, if they expire worthless, they expire worthless. You still get the $2,000. There is no risk to these long puts. You now have a very effective insurance policy against a correction. And you can hold these all the way until about the expiration if you wanted. I usually sell off a couple of these and only hold 1 or 2. The longer you hold these long puts, the more of a move down, the more of a correction that we need, or it really almost has to become a crash at that point for these long puts to really have any value. If they do move, in other words, if the market suddenly corrects, you're going to want to get out of these sooner than later, because the value of these puts will skyrocket, but they'll come down just as quickly if we bounce. In fact, they'll probably lose value faster than they gained value on a significant bounce. So I like to hold these maybe a week after I get out of my good to cancel order at $1.50, or you could do it at $2 and spend $2,000 and end up having a $1,500 credit at the end of this trade instead of $2,000. Now, what's the advantage to that? Well, you're out of the trade much sooner. It's a lot. They're going to reach the spread's going to reach $2 much sooner than it's going to reach $1.50 on those puts that you sold at $10 and bought at $5, and you had a $5 spread. They're going to hit $2 well before they hit $1.50. The nice thing is that you're out of the trade, you're out of the risk, and you end up with 3 long puts. So let's talk about the different kind of markets that there are. And then there's probably 100 different descriptions of markets, but I like to put them in one of these 5 types. It's either going up fast, or it's going up slow, which is the way the market normally goes, just kind of grinds up. It can be consolidating and going sideways. It can slowly melt, very choppy, or it can go just crashing down fast. Now, of these, there's only one scenario that's a problem, and that's when we're slowly melting. Remember that bog of eternal stench. You don't want this trade to slowly be chopping down 40 points, and then another 40 points, and then another 40 points, and then, a month and a half later, we're down 200 points. That's where this trade gets into trouble, and it's the only market that gets us in trouble. If we go down fast, we start to get those 3 extra long puts really start helping us. If we go up fast, everything, all the extrinsic value just bleeds out, and you can get out of this trade very quickly. If it goes up slow, that's your 45-day type holding period. If it goes sideways, that can be between 45 and 60. It can. But when we go slowly down, we start falling down that little slope that really looks ugly in the examples we showed earlier. So, what is the adjustment point? The adjustment point is looking at that magenta T+0 line. Now, this is what I do. Remember, if the max risk ever reaches $10,000, that's as much as we are willing to accept. If the trade is down $1,500 at that point, then, and we can't correct it, or it doesn't seem reasonable that we could correct it, then if the max risk, according to that magenta or whatever color you have yours, but that T+0 line ever gets to be below 10,000, then we need to exit the trade. Now, again, if we can adjust it reasonably and keep that low point, the lowest point of that sag at 10,000 or less, we're going to stay with this trade. If it ever goes below that, if that 10,000 becomes 13, it's time to get out of this trade. And it's just that simple. Most of the time it's going to sit right between $4,000 and $6,000, but every once in a while the market gets into a choppy, slow melting scenario, and you can see this exceed $10,000. So, let's take a look at this. Do I need to adjust this trade? Well, where's the lowest point on this magenta line? Well, we've got a low point here, and that's at about 5,000. Our point of no return is if that sag comes down here to 10,000. We're not there yet. So do we need to make an adjustment? No, the T plus 0 line is not at a potential $10,000 loss. We do not need to make an adjustment. Could we exit this trade if it got down there? Well, sure we could. This is where our gain is. We're up $1,000 in this trade. Could we take that trade? Take that profit? You sure could. There's no reason that you have to stay in this trade all the way to the 45 days. If you're comfortable with the $1,000 and you think, well, we're headed into a very turbulent time where volatility could kick up, there's no harm in taking a $1,000 gain. There's no problem with that at all. So you get the choice. So let's take a look at another scenario. Do we need to make an adjustment here? Well, now the T plus 0 line has sagged down to almost $10,000. Here's your $10,000 loss. Perhaps you do. That really is up to you. You have to make that decision. The trade is dangerously near our potential $10,000 max loss. If we crashed 14% tomorrow, now there's a very slim chance we're going to go down 14% in one day. But as I found out in August of 2015, that can certainly happen. So are you comfortable with the risk now? Do you feel that you can adjust it to protect yourself? Do I have a profit in the trade? Well, yeah, I might have a profit in the trade. So maybe I close part of the trade. Maybe I sold 10 and I bought 10, and when I open the trade for a $5 credit, I can close one of those diagonals right now, as you can see in that purple box, at $2.90. I brought in $5. I can buy it back, one of them, for $2.90. I'm going to book some profits. Now, I'm going to lose the opportunity for that diagonal to go from $2.90 down to my good till cancel of $1.50 or $2 or wherever I set it. So I'm giving up that potential, but maybe that will make me feel better. And I can just, let the remainder of those spreads, maybe instead of getting out of a good till cancel at $1.50, maybe I get out at $1. Maybe I can change that and make it up that way. That's completely up to you. It depends on what your trading plan and what your particular risk tolerance is. What's another thing I could do? Well, how about if I buy another long put? So maybe I'm not at 13, maybe I go up to 14 long puts. Now keep in mind, depending on how long I've been in this trade, those long puts have been melting away. They've dropped from $5, and in this case it's down to $1.40. And you can see that I've already made one adjustment here, and I no longer have 13 and 10. I now have 12 and 9. So I've already done the diagonal, or I've taken one off. Maybe I go and say, well, I want to add one back in. We add one back of my longs. So now my ratio would go from -9 to +13. Well, that's just fine too. You still have a lot of money that can be made in this trade, and you have gone through and adjusted through a very unfavorable market and still made a reasonable profit. Maybe you don't make the whole 2,000. Maybe you make 1,200. That's still a very good return on a trade that gave you protection against a crash or a very quick correction. Let's go through the math on this. We sold 10 puts at $10, brought in $10,000. We bought 13 at 5, spent $6,500, ended up with a credit of $3,500. And let's say we bought 1 or 2 additional puts, and let's say we got it at a really bad price. We didn't get it at $1.40 or whatever it was there. We paid $2.50. In other words, they only dropped from $5 to $2.50. And then we had to make the adjustment because our T+0 line was sagging under the $10,000 line. Well, we spent $500 of that $3,500. I like to call it a line of credit, right? Because that's what's in the trade, and we've got that in our account. We can do whatever we want with it. But I take that $3,500 credit or line of credit. I spend $500 of it, and so I still have my good to cancel at $1.50. So when that does go off, I'm going to spend $1,500. Now, this assumes that I still have 10 shorts and 13 longs. And so I'm going to get rid of 10 and 10. I've spent $2,000. What's the end result? I got $1,500. Plus, I have 4, maybe even 5 long puts. Maybe you do this right before an election or some kind of major news thing like a fiscal cliff or something, and you have a little extra protection that's completely paid for. Now, how cool is that? So there are many scenarios in which that you can exit this trade, and there are many scenarios in which that you can enter this trade. This is the basic way that I do the trade, and I make money on this between 70 and 90% of the time. And the times that I lose money, it usually isn't all that bad. No loss is good, but it isn't all that bad. All right, so what's the bad news? Well, because of volatility, down days are really bad. In other words, if we have a very moderate down day, maybe the market's down 2%, this trade is going to look horrible because of volatility. Those extra long puts will start to inflate, but those short puts will inflate just as fast or faster. So down days are really bad. And unless there is reason to believe that they're going to continue, they are just something that we have to live through. We don't always have up days. The first 100 points of a pullback are very painful to watch. In other words, now this assumes that the market is somewhere between the 2,000 and 3,000, maybe 3,500 on the SPX. After we get above 3,500, maybe the first 150 points of a pullback are painful, because we start to slip down that slippery slope pretty quick. But after we get beyond that, well, those extra long puts start to kick in, and we start going back up. So the first 100 points, or maybe the first 8 or 10% of a correction, is really painful. Margin requirements will inflate, and sometimes they're changed. In the middle of a trade, your broker will tell you, hey, we're going to require more margin for a trade based on how far out of the money you are. That can happen. So you are subject to your broker making margin requirement changes. So, and nobody can tell you whether that is or is not going to happen. That is a decision that's made by your broker. This trade is really boring until we have a down day, and it gets pretty exciting in a way we don't like. every up day or every sideways day, this trade just makes a little bit of money, and it really isn't any more fun than watching paint dry. But you come back after a week or two, and hey, I'm up $200 in this trade. You come back after another week or two, hey, I'm up $700 in this trade. It's boring on a intraday basis. The good to cancel orders, they're like I say, it's like watching paint dry until the week after monthly expiration. Remember, we're getting a 90-day expiration in 120 days. So you're going to run through some monthly expirations on here. If you're holding this 45 days, you're definitely going to go through one, and in some cases, 2 monthly expirations. Well, right after monthly expiration, volatility changes, and that next week, boy, you can see this trade all of a sudden pop up into, from where you were up $400 to being up $1,700 in like a day or two. But that usually happens on the Monday or Tuesday after monthly expiration. And we went through what monthly expiration is. Then the next thing is the long puts will lose value quickly in a V bottom. We talked a little bit about that. If and when they become an issue where you can collect on them, you want to collect on them sooner than later. And I realize that nobody knows where the V bottom really will be, and you could get out of them way too early. When you do get out of those, you get out of everything. Don't hold this trade. If you want to hold 1 or 2 extra long puts, feel free to do so. But when you get out of this trade, get out of the trade entirely. All right? All right, so what's the good news? Up days are, they're really good for SaVE. You can see this trade move up pretty quick on a really, really big up day. If we're up 3 or 4% in one day, boy, this SaVE trade just looks fantastic. But on a typical grinding up day, it's like very boring. 68% of the time, the SPX is up in any 45-day period. Now, you can do a spreadsheet on this. You can go down and download all of the closing prices for the SPX over the last 10 years, 25 years, 50 years, whatever you want to do, and compare what the closing price is of the SPX compared to where it is or where it was 45 days in the future from that date. And 68% of the time, the SPX is up 45 days in the future. That's a huge, huge edge. The market has a positive drift over time. Now, that I'm not saying that we don't have bear markets, but bear markets tend to be very short in duration unless we have an economic change that would indicate you don't want to be in a bullish trade. Why would you be in a trade like this if you're not bullish or in a time of buying shares? If you're in a bearish market, you don't put on a bullish trade. Okay? The trade is flexible. You can do 10 and 13. You could do 10 and 12. You could sell 10 and buy 12. You could you can get out of just diagonal. You can get out of, you can add one long put. You could actually cover one of your short puts. Maybe that would be a little bit more expensive than buying a long put, but it would have a similar effect, and it would reduce your risk. You have a lot of flexibility. You can choose to, scenario A, you can choose scenario B, and there's scenario C. We don't have time to go into that one today, but we'll cover that in another video. You want more income? Sell off more of your long excess long puts. You want more protection? Increase your good to cancel to from $1.50 to $2 or maybe even $3, and then you're left with those excess long puts a lot earlier. So you have more protection. You get to use this according to whatever scenario is that best fits your needs. Each tranche, based on what we've talked about in this video, averages about $1,500. Now remember, it's a 45-day trade, so you're not going to get 12 of these. You're probably going to get 8, right? Because there's 8 45-day periods in a year. 8 times $1,500, $12,000. You're only putting up $25,000 of margin. You know what? That's a nice return, maybe as much as 50% annual return on your margin. It's not a 50% return on your portfolio. I don't know how much of this you're going to use of your portfolio. I certainly wouldn't use my entire portfolio. But on the capital that you're allocating, in this case, that's measured by margin, you could make 50% return. That's enormous. Now, your returns will vary. So, that's the SaVE trade. That's how you get in it. That's how you adjust it. That's when you adjust it. That's how you exit it. That's the good and the bad of it. It's a great trade. The things that you have to remember is that when we're already in a period of the VIX being accelerated, when it's already up extremely high, that's not the time to put this trade on. The time to put this trade on is before you need it, not after you need it. You don't buy this type of insurance after the house is already on fire. When everything is fairly calm and things are moving along, you go ahead and add one of these on every month. And then once we have a volatility event, you cash these in and you sit on the sidelines with this kind of a trade until the dust settles. Don't be eager to put on another one of these 30 days after we've had a 15 or 20% correction. That is not going to work in your favor. You do not want to put these on in an elevated VIX or elevated volatility. What is elevated? Well, you'd have to know what normal is. In most cases, normal volatility on the VIX is about 20. So if we're up in the 30s or 40s or 50s, well, heck no, let's not put this trade on. If we're down in the 20s or the teens, then, the low 20s, the teens, yeah, heck yeah, put this on. This does not do well. In fact, you're not going to be able to model this trade. There's one last thing I'll tell you about, and then I'm going to let you go. There is a spread between the price of the short and the long. We talked about that. One is $10, one is $5. How much of a spread is allowable between the strikes? In other words, could I use a 2,000 strike for my long and a 2,100 strike for my short? If the 2,100 is $10 and the 2,000 is the $5 version, can I use that? And the answer is no. You don't want this really to be any more than 25 points that are difference between the short and the long strike. So let me clarify. If you are selling the 2150, you want to be buying the 2125. If that doesn't model out, volatility is probably too high. It's probably well above 20. It's probably in the 28 to 30, maybe 45, and it's not going to model right. I'm going to tell you I've back tested this, I've paper traded this, and I've live traded it, trying to get in early, and that's the ones that always get me in trouble. What's the widest spread you can do? The widest spread is 50 points. So, for clarity, if you sold the 2150, you could buy the 2125 or the 2100. You would not buy the 2075. You would not buy that one. That's 75 points difference. The trade will get into trouble quickly if you get into a volatility event, especially a slow melt. So if we have a volatility event, we go sideways and then we start to slowly move down. That would be a horrible situation to have put on a SaVE trade when we dropped down and leveled out. That would have been a horrible time in that scenario, because there's no saving this trade. You are going to take a loss, and we don't want to see that happen. So if the spread between the short and the long is greater than 50 points, it is not the right time to put this trade on. Can you have a little bit of flexibility in the price? In other words, could you do $11 on the shorts and $5 on the longs? Of course you can. That's fine. It's a little bit more risky. You're bringing a little bit bigger credit. It'll be closer to $6 instead of $5. Understand, with the more credit, the more risk. But that's perfectly okay if you're comfortable with that risk. I've had all of those trades work out for me. I do that frequently. But for this presentation, I'm trying to keep it very simple, middle of the road. Can you take $4.80 on your credit? Well, you could. I don't do it, but you could. It'll still work, but you're cutting your profit down because you're only bringing in $4.50. You're not bringing in $5, and the difference between $4.50 and $2, if that's where you have to get out, is not nearly as attractive as if it was $5 going down to $2 good till cancel order. So, there's a limit. I wouldn't go too much below $5 on that spread. And keep in mind that that spread's going to look a little weird because you're going to have those 3 extra long puts. So it's not going to be $5. It's going to be $35.45. It's going to be $32.75. It's not going to be $5 because it's ratioed. You're selling 10 and buying 13. You can, if it suits better for your broker-dealer, you can enter this trade by doing the diagonal. In other words, selling 10 and buying 10, and get that filled. And then as soon as that's filled, buy the 3 extra as a separate trade. As long as you end up negative 10 or short 10 and positive or long 13. Now in the SaVE 2, I do it a little bit different scenario. The ratio is slightly different, and I bring in a little bit more credit, and I use that credit to buy more protection. But we'll talk about that in the SaVE 2 or SaVE 3 video. So again, if you like what you hear, please hit that subscribe button. We can't go on without you. And come back often, tell your friends, and remember, good trades.